Hey everybody, Signa here with the Bullish Bears. So today we're going to talk about one of my favorite subjects, and it's got to do with overall market behavior, market attitude. It's called trend days, and what we want to distinguish is this very unique situation in the market. Right, most days are a range day, or there's some form of a range day, and in our market we typically get range days that turn into a little bit of a trend days that form back into a range day, or just a pure range day, or a pure trend day. Now, there are other types of market conditions. Of course, you get your catalyst days that just go parabolic, um, but that's a completely different kind of market. Something that you could think about for an example of that kind of market would be, say, when Boeing had bad news, and then for a few days afterwards, their market just completely tanked, right? So, since Boeing at the time was a financial hedge and was a major market mover in the Dow, there were a lot of market makers and hedge fund managers and the others tied into that. And so it behaved in a very erratic and uncontrolled fashion. But that is separate. A catalyst day is a day that's reacting due to um, strategic market positioning, and not because of a quote trend day or a range day. So in this video we are going to talk about trend days. We're going to talk about how to identify when a market is going to be a trend day. Now, of course, there's nothing that's ever certain in the marketplace. So what we do is we start with the assumption that it's going to be just another range day, because the range days make up most of our market. 65 to 75% of all days are range days. And so we start with that assumption that it's just going to be another range day. And then you need to prove to yourself that today is different and today is going to be a trend day. And we can do that with a checklist that gets us prepared for the marketplace. The main thought behind this is that you should have every day a idea of how you're going to trade today's market, and you should have an alternative plan, so that if your plan is wrong and the market is doing the complete opposite of what you thought it was going to do, that you would have like a plan B. All right, so trend days. We're going to talk about what a trend day is. We're going to talk about a checklist that we can use in the morning before the market opens to help us try to identify, is today going to be one of those trend days? And then we'll talk about the indicators that work in a trending market and the types of trades that you might want to trade in a trending market. So you have to prove to yourself, to build that thesis, today is going to be a trend day. And the way we do that is with a checklist. So we're going to start out with the idea that today really is a range day, and we're going to go through that checklist. And if we can check enough items off of that list, then we would begin to anticipate a trending market, and we would set up and act accordingly and look for those types of trades. Checklist. I've talked about the checklist now a couple times. So the checklist, on the list, we want to identify, was there a gap overnight? A lot of us on the Thinkorswim platform, we set our charts to show us Globex and the pre-market hours. And so it doesn't really come to mind right away, if you're a newer trader, that there really is an overnight gap. Just because you can see candles there doesn't mean the market isn't gapping. It just means that you're not recognizing it for what it really is. All right, so if the market closes at $5 and it opens the next day at $3, it gapped. Now, just because the candles moved through the market, in the pre-market or after the market closed last night, it's still a gap. All right. Was there overnight news? Did a plane crash? Did earnings come out? Was there a statement? Was a CEO arrested? Was there overnight news that would make you anticipate that today could be a day where the market runs, right? A trending day. Catalyst events. That could be, again, somebody getting arrested, uh, major breaking news about any particular strong market like Boeing. Boeing is considered a strong market. It can definitely move the Dow and drag it around. We've seen the same thing when Walgreens missed in our earnings and it dragged the Dow down for a couple days. So these types of events can affect not just a single market like Walgreens or Boeing, but it can affect an entire marketplace like the entire Dow. Right? So we want to be able to identify in the pre-market hours, is there some kind of catalyst events causing this market to perhaps become a parabolic market, right? We also want to identify in the pre-market, is the pre-market making a run? Are we seeing highs in pre-market? Are we seeing increased volume in the pre-market? Did the overseas markets make a run for it? So did the FTSE, did the DAX, did they close high on the day? Did they close making a run? Is there really high volume and is price popping at the open? We want to look at any open range strategies, whether you're using a 5-minute, a 10-minute, a 30, or an hour. Do any of the price open range strategies apply? Has market popped from the open and continued to run and never looked back? After the first hour, is price still running? Has it pulled back in the other direction to cause a range bound market? At noon, is price still running or has it pulled back to create a range bound market? In the overseas markets, we've got Asia, we've got Europe, we've got the NKD, which is the Nikkei, the GDAX, the German ETF, the DJSH, the Dow Jones Shanghai. We can look at all of those markets and try to identify how did their market go. Did they have a trend day or did they have a range day? We can look at the futures markets. Are the futures markets running? Did they gap in the overnight hours? Is there a reason for the futures markets to be running? Is there a stock that's affecting them? Is today a Fed day? Is there any major market news expected today? And these are the 4 futures markets that we want to keep our eye on. And they're each connected with different types of stocks. So for an example, the NASDAQ, right? We consider that the index for tech, or the Russell, the small cap, right? So the Dow Jones, it's a basket of like the biggest blue chip stocks, right? It's 30 products. Each of these represent different parts of our market, and yet some of the marketplace that we trade are in more than one of these. Pre-market news. Is there any catalyst event, any major news? Is there specific index actions? In the overnight hours, was there anything that could cause this market to run? Did anything happen to a specific symbol, like the like the Boeing incident with the airplane, and then the market tipped over after that? The Dow has 30 stocks, and it only takes one major market to pull it lower, like I was talking about earlier with Boeing and Walgreens. The open gap. Is there a large gap at the open? Now, this one, it's kind of relative because what I might consider a large gap, you might not consider a large gap. Each market gap is different. A a $2 gap in something small like Sirius XM radio, that would be a really big gap. A $2 gap in Amazon, that would be nothing, right? So a large gap, you kind of got to take that. Um, it's got to be relative to what it is that you're looking at. Don't get too hung up on this one. Just recognize when there is a massive move in the pre-market, which would cause a market to have a gap at the open. Recognize the fact that a gap market tends to fill the gap before making a move afterwards. Right? So if something gapped up in the pre-market at the bell, it could very well fall back down to close the gap before running higher. You need to be prepared for that type of reversal, even if you're looking at a very strong trending market. Time of day. Different parts of the day, the market reacts differently. We've got the overnight hours. We've got the hour before the open bell, the first hour after the bell, morning session, the lunch crowd, after lunch, afternoon, and then the close, the power hour, right? Each of these different times of day have different market structure. You need to be able to recognize those structures and to understand and identify what time of day it is. Unusual activity. After the market is open, are you seeing a lot of high tick extremes? Are you seeing a lot of market breadth extremes? Is there high relative volume compared to the last 2 weeks or 10-day average? High volatility or high expansion or breakout? Did any of these things happen? These are all indications of a trending market. In the first hour, recognize that a trend day would not have turned back. A trend day would continue to run. During the first hour, has the news increased on whatever it was that was pre-market news? Or has the news affected other indexes? Has price yet set into a boundary? Did it move lower and then rise back up? Did it rise at the beginning but yet now pull back lower? That would have offset a trending market to perhaps start to recognize that a trend is no longer there. Is there unusual volume? All of these things are what would help us identify if we are actually in a trending market. By noon, is price still running? Has price not turned back to become range bound? Is it continuing to set higher highs? Has the news continued to stay on whatever issue it was? Trend day indicators. Moving averages in a pair, 34 or 50, 20 or 50. Play the bounce, trade the fade. You can use the 50 EMA as a break of a trend day. If price crosses through the 50, trend line is broken. It's no longer a trend day, and we are now in a rounded reversal. And that's what that called when a trend day turns into a range day. Trend day indicators, the best indicator that you could use are drawing tools like the price line, the regression tools, and the channels. Trade the flags, breaks and bounces of the moving average. Trend day indicators, look at the volume. Is the volume higher than the average? Use a tool called the volume average MACD. With the MACD volume weighted MACD, you can identify momentum and trend in the volume because it's a MACD that it reads volume instead of price. So instead of seeing trend and momentum in the price, you can identify trend and momentum in the volume. Are the market breadth indicators still at the extremes? Are there any candle patterns that you can identify? Trade the trend. Trend trades are completely different kind of trades compared to range day trades. Use retracement trades to the moving average. Trade flag patterns. Trade breakouts. Trade moving average stops. Use trade tools. This is for any market. What was yesterday's price high, low, and close? Draw those lines on today's chart. Use the ATR. How far is the marking that you're looking at supposed to run? Use floor pivots. Look at the volatility. Volatility is movement. The higher the volatility, the more a market could move. What's the expected move? Watch the money flow. Watch the tick. If you're going to trade aggressively in a trend day, you could identify your bounce setup and take the measurement to already know where your stop would be, where your target profit zones would be. You can set the order at support and set your exit order before even getting into the trade. A bounce setup would use entry logic with stops based on the anticipation of a bounce. The entire trade can be set up in advance. Know your trade logic and take target profits. Aggressive trade logic. Know your distance and risk reward ratio. Have your order ready to go. Answer all the questions that you need to answer to take the trade and follow your plan. In anticipation of a trade, you can measure your trade from entry to exit. You can determine your stops and your target profit zones. You can measure the trade with Fibonacci and calculate the risk reward ratio. If you don't know the answers, don't take the trade. Conservative trade logic is waiting for confirmation. Know your distance and your risk reward ratio. Use trendline setup and measurement. Set your order at the break and set your exit at the fib. Here's a really good representation of a range-bound market. So you can see it had a high, price was trapped, there was a low, and it just stayed range-bound, right? And that was the later half of the day. And really, we could kind of move that over and define it a little more accurately than that, since the front of this actually did belong in a market that had been trending in the first part of the day. And so while we're here and we're just looking at this range bound market, you can see the moving averages here. There's no value in these, right? We could trade this from high to low, from low to high. We could and try anticipation breakouts above or below, but we don't have a trending market here. So we could use stochastics and RSI on a market like this, but we couldn't use moving averages. We could trade it from low to high or trade the breakouts, but we couldn't fade this. We wouldn't want to try fading a trade like this. But in the earlier part of the day, and this happens quite often, started out in a trending market on a trend day and then ended up in a range bound day. All right, so you can see how the moving averages here, this offers us some value. Right, now I've got my moving averages set a little higher, but you could use something like the 2050, and you can see that you get the run, the pull back to the moving average, run, pull back, run, pull back. That is classic trend uh, trend market, right? So you can see a lot of value in this, and this is where I was talking about in the video, where an aggressive trader would not have waited for the break here above the high to get into this market in this leg up here right here. They would have taken it down here. An aggressive trader will not wait for confirmation, but rather anticipate his trade entry. A more conservative trader would not have taken the anticipation trade and would rather have waited for the breakout. There's nothing wrong with either one of those two trades. It just fits your trading style. You can see that the moving averages offer you a distance to set your stops. If you don't trade with stops, you could at least use the 50 moving average as a point of no return to exit your trade, or to identify the distance in percentage wise that you would not tolerate for exit strategy, right? So if this distance here is 20 cents, maybe you want to take at least 40 cents up, right? That way you're getting some type of ratio. All of that has to be a part of your own trading strategy. That's not really the focus here. The idea, though, would be that since you can trade a trend day in anticipation, it gives you time to measure the distance that you plan to make. You can use expected move, you can use Fibonacci, you can use average true range. That way you can identify, is your target goal more than what this market could give you? That way you're not trying to reach for something that you actually can't achieve, right? And we can throw Fibonacci on there from leg to leg. Say we were looking at the move here, and we had our retracement, and we're looking for the next leg up. We could put our Fibonacci on there, and we could say, all right, so we've got our 100%, and our next leg would at least make it to the 1, 2, 3. So we could use that as our first target. Say we want to fade the trade. All right, we could take a little bit of profit here when we hit the 100. And we could maybe take half of our position off here and then leave the rest on for a runner. Whatever your trade logic is, you could use the Fibonacci extensions to identify the next leg or the next level up, right? So if you were a confirmation trader and you're waiting for the breakout above this area, you could at least identify now where the next stall might be, and then anticipate your distance in the trade to fade in, or add to your position, or look to take money out of the trade. Make sure you get paid. Take risk out of the position. Perhaps take half your trade off, and then another quarter, and then leave some on for a runner. Whatever your trade logic is. So the slides are good to talk about this, but in the end, we just got to, bring it to the charts and look at some pictures. This is a range-bound market. This is a trending market, and it works in the same way in reverse. We trade this completely different. Most of our trading days are range days. So we start the day in the anticipation that it's going to be just another range day. And we'll go through the checklist looking to convince ourselves that we are actually going to be having a trend day and not a range day. The rules that we use to trade a trend are different. The tools that we use are different. Our distance in the trade is different. This video is a discussion about recognizing before the bell that we could have a trending day, and then we would trade accordingly. Here's a great example of a market that had closed and gapped in the overnight hours, and we could see that before the bell we were getting aggressive trading action in the pre-market. The market retraced to try to fill the gap and then it took off. That one pullback to the 200 was the only pullback to the 200 we saw until almost the end of the day. We didn't have a rounded reversal necessarily, but we did have a trending market that turned into a range bound market. And that is when you can identify this kind of price action before the day begins, you can anticipate the kind of trade strategy and trade logic you're going to use for the day. Now, if you're a day trader, you might be used to trading a lot of low float stocks that are popping on momentum. Those do not exactly fit into a quote trend day, but their candle patterns can absolutely mimic this same trend shape, right? And that's another great reason to recognize how these moving averages can really help you in a market that is exploding in momentum, right? If you have very strong trend market, there you go, right? So you get a strong move and a pullback to the moving average. Strong move, pull back to the average. Strong move, pull back to the average. This mess right here, this consolidated area, and then a strong breakout, right? So this absolutely can be applied the same way, right? You got the same type of candle momentum. You can measure and project with your Fibonacci in uh, a low float market the same way that you can in a really good, strong market like SPY, right? It's the whole idea of anticipating a trending market versus a range bound market. Now, I am going to do a video on range bound markets, different ways that we can trade them, and we don't have to try to identify them since, most of our trading days are range days. But we trade them completely different. We use different tools for those, and so I will end up doing a video on it. But I just wanted to do one first on trend days to show that you can anticipate those types of days, or you can get a day where you start out with a range bound market that turns into a trending market, especially if you're watching a low float stock that is ranging sideways and then gets a strong breakout. So for an example, right here in this market, we had started out with a strong downtrend and got stuck in a range bound market, and then we had a strong explosive move to the upside. So we went from range bound to trending and then back to range bound again, right? So you can't always just have one type of day or just use one set of tools. And I think that this is where a lot of people end up making mistakes, mainly from the simple fact that they never really thought about a range bound market with its own strategies, its own rules, its own uh, trade logic versus a trending market with its own rules and tools and strategy and trade logic. But now that you see it, I don't think you'll be able to miss seeing it from now on when you're looking at the charts, right? This was a day where we were strongly trending down, consolidated for a while, and then did the absolute opposite, right? This is a rounded reversal right here. Okay, so I hope you enjoyed this video. I appreciate you watching it, and I look forward to seeing you at the next one.